This is Trading Day Live.
Hello and a warm welcome to Trading Day Live. I'm Leanne Jones. We are 2 hours into this trading session and we are seeing a bit of weakness across the screen right now for the ASX 200. We are off about 0.15% or almost 10 points there. Similar performance for the All Ordinaries. It looks like we are tracking some weakness around the Asian region as well, but of course it does come off the back of some weakness and an escalation in these trade tensions seeming to be impacting sentiment more broadly. Close watch on the telco sector there today. We are seeing TPG and Vocus really dragging down the telecom space, down 3.6%. Of course, noting though that they were the top performers on the index yesterday after that merger deal between TPG and Vodafone Australia. Also making news this hour, China's manufacturing PMI beating expectations, rising 0.1% in August, and Transurban picking up a 51% stake in WestConnex for $9.3 billion. Let's actually get you through some of the best and worst performers as we are heading through this session there. We mentioned broad-based weakness across the index there, but of course there are still the performers on the upside. You have Bapcor, which is actually right at the top of the list there today, up 2.3%. Primary Healthcare, Ramsay Healthcare. An interesting one because of course it reported yesterday where those net profits did slip, but stripping out some of those one-off costs because they did announce some write-downs and restructuring costs, we did see their underlying profit rising almost 7%. A lot of brokers weighing in though on Ramsay Healthcare today. Morgan Stanley raising its price target by 12% to $56. Citi lifting its price target 1.6% to $62. You then have at the other end of the scale Credit Suisse, Macquarie and Morgans all lowering their price targets there after that result from Ramsay. So a couple of those broker moves that we are just watching on that front. And you have Blackmores up about 2% there today, again after its result earlier this week. And Beach Energy just rounding out the top 5 performers. Afterpay has been doing pretty well, not in that list there at the moment, but resuming its trend higher. Let's switch across to the worst performers through the session, and you have Sandfire Resources right down the bottom of the list, down 7.6%. A lot of those mining stocks actually, we did see broad-based weakness across the commodities complex heading into the session today. Mineral Resources, the second worst performer. You've got Syrah Resources, Resolute Mining, and then TPG, I mentioned it was the top performer. A really good move yesterday, and that was after that whopping $15 billion deal between TPG and Vodafone. But today, just giving back some of those gains, much like we are seeing for all of the telco sector there today. We mentioned it is the worst performer, down about 3.6%. Let's get you across some more analysis on all of those market moves as we head into the third hour of this session. Ben Brun from Australian Stock Report joins us live from our Sydney CBD studio. Look, Ben, a very good afternoon to you and thanks so much for joining us. The last session of what's been a very, very big week of reporting season. What have you made of the first 2 hours of trade today?
Not surprised to see us slip back a little bit on the back of the performance of the US last night, and of course trade war on everyone's lips again, which has been a shot in the arm earlier in the week, obviously with the US and Mexico getting to the negotiating table, but you know, Trump talking about China and the potential for these $200 billion worth of tariffs to come in as soon as next week. You know, the US market's probably got off a little bit lightly because if that does come to pass, I think that we're going to have to pay the piper, unfortunately, in particular out of the US. But of course, the old adage, when the US sneezes, we're going to catch a cold here. So that, you know, that's a big reason why we remain cautious, but at the same time, a little bit optimistic as well. I know that's sort of hard to sort of compare the two, but if we know Donald Trump is you know, like a dog whose bark is louder than his bite, and if they are to sort of put these tariffs behind them and we can sort of get on with business, then global affairs are looking pretty good. And I think we have the ability, especially on the back of some of the earnings that we've seen, to maybe propel ourselves towards 6,400. So there's a lot in flow at the moment. You know, speaking about this session in particular, we've got US futures, which are trending a little bit low, which is not helping the complexion, but we're only down sort of 9 or 10 points. So nothing here or there. And really, most of the negativity has been felt in the telco space. I thought it was a little bit of a game changer yesterday for that tie-up with TPG and a lessening of competition, but and a broker upgrade today from TPG. So I would have thought they'd be able to follow on with that momentum. So far this morning hasn't really materialised that way. So look, there's a lot to take stock of analysts are pouring over the earnings at the moment. I still think that the ones that did impress and the ones that beat expectations are probably going to be rewarded going into the February first half reporting period. In a similar vein, unfortunately, some of the ones that disappointed, probably that momentum will continue on the downside as well. So, yeah, a lot to take stock of. Haven't even mentioned the political spectrum, but we're certainly going to have a petition out at the Australian Stock Report to save our franking credits. Watch out for that, because we feel very passionately about that. But that's probably a story for another day. I think we've covered off a lot there, Leanne. Down but not out, but still very, very cautious.
Yeah, absolutely. So many things going on, obviously impacting the environment at the moment. But look, let's delve into some of the reports that are out today, and then I might get to how you're positioned as we are coming out of a reporting season. But let's start off with the NextDC. There's been, a bit of volatility, you'd have to say, in the stock today. It opened at about $7.37, jumped as high as $7.60. It's now back down to about $7.21, a low of $7.06. So it's down about 2% at the moment, reversing some of those gains that we were watching earlier. Just after the back, of course, of its result there today, EBITDA, $62.8 million, so a bit of a rise on that front there, and obviously with their outlook as well. So perhaps you can tell us a bit more about what you made of those numbers and why we might just be seeing so much volatility in the share price today.
I think while we're seeing volatility, look, first, foremost and uppermost, we thought it was a nice set of numbers. We think it's a great stock as well, and any sustained weakness we'll be looking to build positions. This is one that we've been following for quite some time. It's one of those nosebleed multiple stocks, and despite the fact that the numbers were very, very nice, you still can't get your head around triple-digit price to earnings ratio for any stock. For my mind, is a little bit, dare I say it, unpalatable. But if you held this in your portfolio, and there was, well, certainly if you saw some sustained weakness over the coming trading sessions, we would be looking to add to positions for absolute sure. And this is one, that for the long term holders, we certainly think, and we're very confident in the stock. They've raised capital earlier in the year. They've been building out their storage capacity. All this cloud-based technology and data infrastructure. This is what they cater to beautifully, and that's only growing. We think that that now that they've got their capacity numbers headed in the right direction, they're going to be bringing on new clients, and this is just going to fill out that storage capacity very, very nicely. So it's a story we really like. But to answer your question, why is it so volatile so early in the session? It's because it trades at a triple-digit earnings multiple, and we're not just talking about for this year, we're talking about for next year and the year after either. So a lot of it has already been priced in, unfortunately. We still think you'd do all right over the next 5 to 10 years with this one. Okay, so you'd stick with it. You wouldn't look to sort of take some profits giving those multiples? No, we wouldn't, but would be adding to positions, as I said, if we see sustained weakness.
Yeah. Okay. Let's have a look at Harvey Norman in the retail sector there today. It's on the flip side of things, actually. A bit of a drop. I think it's had its biggest fall in about 6 months or so off the back of its earnings report. I'm looking here. It's down 4.4% at about $3.60 at the moment. The market has perceived it clearly as a weak earnings result. What did you think of it?
Well, if you take the headline numbers, we thought, I certainly think it's weak. This is not one that we follow at all. So I'm speaking a little bit off the cuff here, but it's discretionary retailers we do not like, and Harvey Norman obviously falls into that space. Now, what usually supports the numbers, you see some of some of their store sales are only so, but it's the property revaluations which really help this stock along. But they've gone the other way this time around, and I think that there could be that might make for a little bit of a sea change. And in terms of the future, you've got the cautious consumer here in Australia, and you've got the economic growth and wage growth numbers that are really disappointing. So you might have disappointment at the store end. But if we see again, if we get a change of government, we're talking about the end of negative gearing as well as franking credits. That could be a real double whammy. I'm surprised that Harvey Norman's only down by 4%, and of course a capital raising to boot, a very heavily discounted capital raising. I'm pretty sure it was at $2.50. I'm surprised by the strength we're actually seeing at this stage in the stock. Of course, everyone will point to the underlying earnings only being down 1% and probably their second best performance ever. The great famous trader says it's not called underlying earnings, it's called lying earnings because it does take an impact. And of course, that dairy farm, I don't know what he was thinking there, old Jerry, but that's taken a big chunk out of the pie this time round. But it's the property revaluations. As I said, it could be a double whammy. We're not in discretionary retailers for the most part across the board, but certainly not JB Hi-Fi or Harvey Norman. I'd probably err on the side of maybe selling, especially if you can get your hands on some stock at $2.50 with this discounted capital raising.
Okay, so if you're not in the retailers, then what are you in? Obviously, at the end of reporting season, you've had a chance to sort of delve through all of the numbers, some hits and misses there clearly. But how are you guys positioned at the moment?
We're very happy with how reporting season played out for us and the stocks that we're recommending. I know overall it probably did disappoint a little bit in the round. We've had Appen and Altium. We've been in some of the healthcare stocks, Nanosonics. There's always opportunities out there. As I said, we're very happy with the way certainly the stocks we've recommended have performed. We're still poring over the numbers, to be quite frank. I mean, Boral was another one that we like. We still like the exposure to the US housing story. We think that the likes of Altium and Appen still represent opportunity. So does NextDC. We're probably just looking for a more attractive entry point. Ditto something like Magellan. There were some of the best names that we had that performed very, very strongly in earnings season. Speedcast really was the only one that sort of disappointed us a little bit, but we think we'll be able to get back some of the money potentially that clients have lost there. We think that'll go back into the $5 at some stage on the back of the acquisition. So, look, there's a host of names out there, but as I said, we were very, very happy with certainly the stocks that we recommend and how they performed. So we'll be looking to add some positions and maybe even we'll have a few new stocks that we'll be talking about in the coming weeks and months ahead.
All right, fantastic. Well, we'll look forward to talking to you about it as you do have those new stocks. Ben, we hope you have a wonderful weekend. Take a good break after what's been a very busy week. Thank you so much for your time today.
Thanks, Leanne.
Ben Brun joining us there from the Australian Stock Report.